The S&P 500 over the past 99 years has closed up more than 73% of the time. Unfortunately, market volatility and intra-year drawdowns usually shake investors out of their bags, causing them to miss the recovery before the end of the year. Let's see where 2025 ends up and beyond. Welcome back to Mark's Financial Playbook. If you're new to the channel, my name's Mark Basil. I'm actually a financial advisor. However, this deep dive is not financial advice. I do work closely with our investment committee, and based upon our deep research, today's charts are eye-opening to say the least. Here's the chart showing the S&P 500 mid-year max drawdown, the red dots, compared to the close price, including dividends, at the end of the year, the green or red bars, depending if the market went down. This goes all the way back to 2010 through mid-July 2025. In 2010, the market dropped 16% with European debt crisis and recession fears, but it recovered and closed up for the year 15%. In 2011, we had a huge intra-year drawdown of 19%. This was mainly caused to a downgrade in US credit, but we found a way to close up 2% for the year. In 2012, we went down double digits, 10%, with all the fiscal cliff debate and continued overseas recession fears. But ECB President Mario Draghi made his famous "whatever it takes" speech, and the market rallied and closed up 16%. In 2013, there was a small drawdown of 6% during taper tantrum talk, but it didn't happen. QE continued, low rates, boom. The market closed 2013 up a whopping 32.4%. Pretty remarkable. 2014, we had the Ebola scare. Oil drops, markets sink by 7%. Then we see that domestic jobs actually grew. We ended up closing over 13%. In 2015, China devalued its own currency and the market dropped 12%. The Fed stepped in with rate hikes and we closed up for the year. Just a little bit, but still, we were up. In 2016, Brexit and early recession fears dragged the market down 11%. Feels like it was just yesterday. But the US election triggered a Trump rally, and we closed up 12%. 2017, only a 3% dip during the year. Low volatility and synchronized global growth led to a 21.8% finish. 2018, down 20%. With trade and war fears and multiple Fed hikes, the Q4 crash was brutal, and the year ended up down 4% in the red. In 2019, we had a brief 7% drop, mostly from lingering concerns, then a massive rally as the Fed pivoted and we closed up 31.5%. Enter 2020. COVID rocked our world like we had never seen before, and the market crashed 34% in just a few days. The economy completely shut down. This caused a massive federal stimulus package that saw the year make one of the biggest recoveries of all time as we closed 2020 up over 18%. Feels like it was yesterday. 2021 saw a quick drop of 5%, then a massive close of the year up almost 29%. As tech surged, we had the reopening boom, but unfortunately, it didn't last. In 2022, inflation spiked. We had the Russia-Ukraine war, and we dropped 25%. We had a small bounce, but we closed down in the red 18%. 2023, banks were going out of business. We go down 10%. Every network and news outlet was screaming from the rooftops, recession. Didn't happen. We closed up over 26%. AI fueled the tech boom and inflation cooled. 2024, intra-year down 8%. Strong corporate results. As the AI boom revs up, we closed up 25%. Now, here we are in 2025. Liberation Day drawdown and war tensions saw the market plummet 18% first couple weeks of April. But so far it hasn't mattered at all. As the Genius Act passed, Bitcoin pumped, AI pumped, defense and tech earnings pumped hard into July. We've recovered fast and are now sitting up for the year. As of the recording, it's up 8% for 2025. Notice a pattern? The markets go down and red pretty much every year with an average dip of about 14%, but the market is resilient and usually finds a way to climb itself back. This chart is a great indication as to why we have to stick to the plan. And history tells us that up and to the right is not just a saying, it's a real thing, it's real data. In fact, the odds of being positive in a given year is over 73%. Let me show you why staying the course isn't just about optimism, it's about historical probability. This chart tracks every single year of the S&P 500 going back to 1926. nearly 100 years of history. The red boxes, years the market finished negative. The green ones, positive years. And get this, the market has been positive 73.5% of the time. Even better, in nearly 60% of those years, investors gained more than 10%. And in 20% of all years, returns top 30%. In other words, the odds are literally in your favor. What about the downside? Only 12.2% of years saw a drop of more than 10%, and just 6% of years ended down more than 20%. And only 3 out of 99 years, just 3%, lost more than 30%. So the bottom line, nearly every single year brings volatility, but history shows us that the odds are stacked in our favor. So when you see that red dot pop up in a given year, a drop of 10, 15, or even 20%, that's normal. So stay the course, stay diversified, and stay in touch with your advisor. If you need guidance, grab the free PDFs linked below or reach out. We're here to help. Thanks for watching, and we'll see you in the next one.